Hello, everyone. This is my latest video in my series, The Not Too Dismal Science of Economics. I'm Philip Soren, Professor of Economics at the University of Winnipeg. Today, what I want to talk about is carbon tax and the carbon tax policy in Canada. As is well known, the goal of the carbon tax is really to facilitate the movement away from the use of fossil fuels. And in a sense, it's called a carbon tax, but really what it is, it's a tax on uh, fuels that, when they're used, emit CO2. So it's in many ways, it's a fossil fuel tax. So it applies to any fossil fuel type energy. The idea behind the carbon tax is like any other policy which is designed to move consumer choice away from one particular product, in this case, the use of fossil fuels, towards other goods and services. And as we know, that if you raise the price of a good or service, consumers generally will look for substitutes to the extent that they can. The one issue that arises with the carbon tax is that fuels are used in conjunction with certain technologies. So, for example, if you're buying gasoline and there's a carbon tax imposed on gasoline, the gasoline is used with the vehicle. So, in a sense, the gasoline that you're using is going to be a derived demand, and it's coming from how much you need to use your vehicle. So for people who have a certain amount of discretion about how much they want to use or need to use their car, then as you raise the price of fossil fuels, then the substitution effect, in other words, the movement away from the purchase of that fuel, will be greater than someone who has fewer options. So in general, whenever you raise the price of a product, there's two effects that occur. The first is that you make that good relatively more expensive. So consumers will naturally switch to alternatives to the extent that they can. So an example is if the price of bananas goes up, then consumers will rationally substitute to other fruits because the relative price of other goods, other fruits are lower than they were before. So you get a substitution effect. But also, when you raise the price of any product, consumers have less purchasing power. And so there's a double-edged sword when you raise a price. So when you raise the carbon tax, you raise the price both of fossil fuels, but also you lower the disposable income in a sense, or the real purchasing power of individuals. So paradoxically, to get a significant reduction in the use of fossil fuels, you wouldn't give any rebate. In other words, you wouldn't give anything back because the issue that arises is when you compensate people, then they may take the extra amount and use it to maintain their purchases of fossil fuels, or, maybe offset it a little bit. But the bigger issue is the fact that the substitution effect, at least in the short run, is very low um, for many fossil fuel using technologies. For example, if the price of gasoline goes up, you're not going to immediately switch to an electric car. It needs to be significant, and it has to be during a period where you may be in the market for a new vehicle. So in the short run, the elasticity, in other words, the reduction in the quantity that you would purchase of gasoline, is going to be relatively small. But in the longer run, if that price is maintains high, then the long run elasticity may be greater. And then when that kicks in is when people move to more fuel efficient cars, when they switch to hybrids, or ultimately if they switch to EV cars. So the short run effect of a carbon tax is going to be relatively modest. The long run effect can be greater. But in both cases, it's observed that it's relatively inelastic. In other words, if you increase the price, say, of fossil fuels by 10%, you get less than a 10% reduction in the use of fossil fuels. And even less reduction in the short run, maybe a little bit more of a reduction in the longer run, but is generally inelastic. So what does that mean? Well, that means to get significant reductions in the use of fossil fuels, those increases have to be quite significant. The other thing is gasoline as a component of the user cost of, say, a vehicle is relatively small. For example, if you have to finance a new vehicle either through a loan or a lease, and the vehicles are in the $30,000 to $40,000 range, then your car payments plus your insurance payments are going to be significantly greater, perhaps, than your cost of gasoline. So in the overall user cost, gasoline is quite a bit less than your other expenses. But the one thing that also I want to talk about is there's the paradox of you might call it a political paradox of carbon taxes. And that is to have the carbon tax have the most reduction in the use of fossil fuels, you don't give any rebates back for the reason that I mentioned earlier. Because if you give the money back, then people may use some of that additional money to maintain their expenditure. It's called the income effect on the use of fossil fuels. But that makes it politically dangerous or politically hazardous, because what you're doing is you're making this a permanent increase in the cost of living for individuals, and not too many people are enthused about that. But let's just have a look at the general payments that you get under the Canadian carbon tax rebate. So I think it's quite useful to have a look. So this is from, I'm just going to share the screen here, and so you can have a look. So as you see, this is the Canadian carbon tax rebate amounts for 2024. This is from the Government of Canada. And it actually has a couple of requirements. First of all is, in order to receive the Canada carbon rebate, Canadians need to file an annual tax return. So you need to let the government know that you are actually a taxpayer. So let's look at the table one. The first one is the quarterly carbon tax rebate amounts specified by the Minister of Finance, and table two is the annual. So essentially, the way the carbon tax rebate works is that it is a per person rebate or compensation, and it's done basically kind of almost on a family basis. So the first adult will get 900 back in Alberta, 600 back in Manitoba, 560 in Ontario, and so on as we go along. Rural will get a little bit more. That's for the first adult. The second adult gets less, gets kind of half of what the first adult gets. And then each child gets 225. So the family of four, if living in the city, would get 1,800, and the rural will get 2,160. And so the federal government argues that in general that you get an average net benefit in terms of the rebate. Now, I'm not going to get into the details about the sort of cost calculation, but the issue that comes up is whether those costs, in other words, the cost impact, includes all secondary cost. And that's usually the big issue because obviously energy costs go into the cost of goods and services throughout the economy. And so in general, you'd want to include what is happening to the overall costs. So I'll stop the share here. Uh, so stop share. Okay, so that is a bit of the summary here is that in general, so let's just summarize the argument so far. So the first of all is the carbon tax is designed to discourage the consumption of fossil fuels. But in the short run, the substitution possibilities are quite modest. So in the long run, they are a little bit greater. In other words, the reduction in the use of fossil fuels will be greater. But in both cases, they're relatively what's called inelastic. In other words, there isn't going to be even a huge reduction unless you switch to hybrids or you switch to EVs. Secondly, is the rebates are not done based on how much you use. For example, it would be easy enough for the government to give you a per person rebate if that was so desired. For example, when you go to get gasoline, you could have a carbon tax card, which you would put in after you filled up, and then it would record how much you purchased, just like any other card you get when you frequent, like an Air Miles or the Scene card. It could record how much you use, and then you could use that information to actually calculate explicitly how much tax you paid. But the government's not doing that. And it may be doing that for a couple of reasons. One is they may think that administratively it's somewhat complicated. But second, notice this current system provides subsidies for some individuals. For example, suppose you use a subway system in a metropolitan area and you don't have a vehicle. Well, you're still getting the carbon tax rebate. So you're actually getting subsidized considerably by the program. And so part of the goal may be to say, okay, look, let's incentivize people to not even have a car. But if you are a user of a vehicle, then you have to accept the fact that you are cross-subsidizing other people who haven't paid into, in a sense, the carbon tax program. You're also subsidizing people who use their car infrequently at the expense of people who use it quite frequently. So the carbon tax program has a lot of cross subsidies going on. And obviously that's probably by design, but in a sense, suppose you're a rural person using your car more than even is expected under the rural rates. But someone in a downtown area is using a subway is getting a significant rebate that you're paying into or other people who are high users are paying into. So you can see why there may be an objection on those grounds. But in general, the carbon tax has to go up at a significant permanent rate to have any significant long-term reductions. Now, it'll have a short-term effect, and there has been some evidence that it has an effect. But to really drive down the use of fossil fuels, it has to be expected. Why? Because suppose you think you're thinking of switching to a hybrid or an EV. If you think that the carbon tax is going to be removed, then and you think that EVs and hybrids are relatively more expensive, then you may decide, well, I don't need to invest in an EV or a hybrid. So you can see where I'm going here is that because you're purchasing what's called a durable good, a good which lasts several years, then you have to project or look forward about what is going to be the cost of the various ways of fueling it. And what's interesting is in places where the adoption of EVs has been significant, people are now starting to be concerned about what's going to replace the gasoline tax, which is used to fund roads, but also they're worrying about what's going to happen to the electricity prices. For example, suppose you did your calculation that EVs would be cheaper because of the price of electricity, but now you have to figure out whether the future prices of electricity will go up. Okay, so I think this is a lot to digest, and but if you have any comments, send them. And if you like this video, please do. And if you like following the series, subscribe and also send some comments. So bye for now.